everyone, and thanks for tuning in to the Economics of Real Estate, the March 2026 edition. This is being filmed April 10th, 2026. Today we're going to cover some Ipsos research. We're also going to look at some economic factors that are shaping the Canadian real estate market, as well as looking at some GTA statistics to kind of see how it's all playing out together. So let's jump into our first slide here. So the Ipsos Issue Watch, most important issues facing Canadians. So the top three that we can see at the top is housing, healthcare, and the economy. Now, with housing being at the top, this is the first time it's been at the top for a very, very long time. So that just goes to show how much housing is weighing on consumers' minds right now. Healthcare, again, one of the top ones, and then the economy at the top. Now, to be fair, the reason I think that housing and healthcare have been at the top here is because we did welcome a lot of new people into the country over the last couple of years. And unfortunately, the governments didn't prepare us enough for that. We didn't have enough housing and we didn't have enough healthcare services to welcome all these individuals into the country. So there was some strain in both of those areas. Now, with population decreasing right now in the country, we're starting to see these services come down. You're starting to see housing become more affordable. You're seeing a lot more rental properties in the market now, so that will factor into prices over the long term. Healthcare, I mean, let's be clear, healthcare has always been an issue in Canada. It did get a little bit crazy over the last couple years, and it will likely stay like that for some time. So those are definitely three big ticket items that are weighing on consumers' minds right now. Next up, we're going to look at pent-up demand. So the black line is the expected home sales based on employed GTA population. So this line is basically just up and to the right, nice and steady. More people join the GTA, the higher this working population will be. And then the blue line is your actual amount of home sales that you're seeing. So we can see that it ebb and flows. Way back to 2011, we had it come above that line into 2016. Interest rates really played a big part in this. Got a lot of people off the sidelines, got a lot of renters out there into the market, and them to purchase with the low interest rates. Interest rates changed, and then government policy changed in 2017, and we saw sales kind of hit those in the 2018 market. And then they started to pick up again as individuals started to come back in the market. We saw interest rates start to come down in 2019 before the pandemic, where we really saw interest rates come down, which also led us into the second peak over here in 2021. But now we've come down significantly since then, and we've really come, way to norm of where we typically would be for employed GTA population purchasing homes right now. So is there pent-up demand in the market? Absolutely there is, 100%. This chart is proving that. Now, what's going to cause individuals to get back in the market is clearly going to be affordability. It's going to be the price of interest rates. It's going to be confidence in the market that maybe we have a trade deal with the United States of America. Maybe we're starting to see wages increase a little bit more, even though it has been quite strong over the last couple quarters. Something else that they're going to want to see is what's going on in Iran. Our oil price is going to go back down. Our food costs go back down. So a lot of pent-up demand sitting in the market. At some point, this will likely flood back into the market. Will it be year? That remains seen, depending on what kind of economic factors start shaping this housing market over the next year. Next up, we're going to be looking at affordability concerns and economic uncertainty, keeping many buyers as only somewhat likely to buy. So the question was, you've indicated that you're somewhat likely to buy a home in the next year. What's holding you back? So 53% of respondents said the rising cost of living. 43% said economic uncertainty. 32% said not sure I can afford it. 23% said job anxiety. 17% Canada-US relations. So we can see the number one issue is the rising cost of living. Unfortunately, a lot of money was printed during the pandemic, and a lot of money is still being printed by our governments right now as they run massive budget deficits. And this has unfortunately caused the cost of living in this country, and not only this country but around the world, because most governments were doing this, to accelerate pretty high. And if you didn't have assets to capture some of this upside on the inflation, the rising living is definitely going to be felt a lot more. Next one we're looking at is the first home buyers are likely to make up a larger share of the buyer pool. So the question was, will you be a first-time home buyer? And 45% of people in 2025 said that they were first-time home buyers. These are the people that were most likely to purchase a home in 2025, which is significantly up from the previous 2 years, which were both 2022 saw 46%, and then 2021 all the way down at 39%. So we can see that we're on where we were in 2022, and then again, we haven't been this high since back in 2016 and 2015. Next up is among recent buyers, first-time home buyers make up 78% of activity, as ladder climbers, downsizers remain sidelined. So we can see that the question was, were you a first-time home buyer or did you move from another home you owned? So 78% said that they were the first-time home buyer. In the 416, it was 87%. In the 905, it was 68%. And we can kind of see since 2024 what those numbers look like. So definitely a lot of activity for the first-time home buyers. Whereas the ladder climbers, either going downsizing or upsizing, they remain on the sidelines, which is quite interesting because in a lot of neighborhoods, and we covered this, I covered in some of my other videos, there are great opportunities for detached homeowners who are looking to either go condo, townhome. The spread between the properties have, in some areas, widened quite significantly. So if you're in a detached home, you want to downsize to maybe a condo or a townhome, you're going to be able to sell that detached home and pocket quite a bit of money in the sale because you're moving down to a much cheaper property type in that area. But there's also areas as well, if you're in a townhome, the move up to the detached has actually narrowed quite a bit. So it actually does make sense for some of these ladder climbers to explore and see if it makes sense. Remember, every market is different. Every neighborhood can be different. Depending on where you're going to potentially sell a property and then move to, the spread between those could be quite attractive for people looking to climb the ladder or come down the ladder. Next up, we're looking at serious listing intentions, hold steady, but soft consideration declines. So percentage likely to list their home in the next year. So the question was, how likely are you to list your home for sale over the next year? And we can see that very likely is at 14% and likely is at 32%. And what we're actually seeing in the market right now to start the year is a lot less homes hitting the market right now, which is helping out when it comes to months of inventory. Because we are getting a little uptick in sales, but we're getting a downtick when it comes to new homes in the market. So the data seems to be holding true from 2025 when this was introduced. Next up, we're looking at the impact of high rates has weakened but still prevalent. So question was, have higher interest mortgage rates had an impact on any of the following? So first up is price of home you intend to purchase at 38%. Size of the down payment, 34%. Type of home you intend to purchase, 29%. Length of mortgage term you will use, 28%. We can also see what the numbers were in the fall of 2023 and the fall of 2024. Next up is the down payments remain strong with good equity positions. So the question was, what percentage of your purchase price will be covered by a down payment towards a mortgage? So we can see for total, the average down payment was 32%. So this is first-time home buyers, ladder buyers, all of that, 32%. When we're looking at first-time home buyers, it's actually fallen back from 2024's high at 29 to down to around 27%, which is kind of where the bottom is when we go back to a lot of these other years. 2018 was 27, 2022 was 27. Let's look at the buyers continue to use, a lot of sources for down payments. And the question was, what will be the source at down payments? What will be your sources of down payments? Please indicate the share of your down payment that will come from each of the sources below. So for total buyer, we can see at the bottom here, 28% is savings outside of the RRSP, 13% is savings within the RRSP, 16% is gifts from family and friends. So actually a big number when it comes to gifts, even for all types of buyers. 21% was equity from the current home that they're living in, and the 14% was some other form of financing, and then 8% was for other. Now, when we go to first-time home buyers, we're looking at savings outside the RRSP of 31%. 18% came from the RRSP, 21% came from the parents. So, and it even breaks it down further here. 12% from the parents, grandparents 6%, and I have friends with 4%. Man, I wish I had friends like that. Now we're looking at equity from the current home is 6%. And some other form of financing was 16%, and then other was 8%. So this gives us a great view as to where people are getting their down payments from. Okay, so now that we got that kind of overview of the Ipsos research into the market, let's also look at some of the economic data in the market as well to give us a better idea. Is 2026 be the year where prices bottom out, or do we still have a little bit ways to go? So let's start with the Canadian unemployment rate, which is sitting at 6.7%, which is down from the 7.1% that we saw last year. But I don't think we're not in the right direction. And a couple of big factors for that is the trade war that we're seeing with the United States of America. They've come out and they've said, that they want to be a bit more self-sufficient. They want to bring a lot of manufacturing back to their country. That will remain to be seen if how viable that is, and also how much is Trump just trying to negotiate a better deal when it comes to Mexico and Canada and the trade that we have between ourselves. But we're not going to see a significant movement in activity in the Canadian housing market until there's more confidence that the job markets is going to start strengthening and improving. Next up, we're going to be year over year wage growth, and we're looking at 2% when we're looking at year on the weekly chart. So we can see that we had some significant wage growth activity back pandemic first started. It then came down to more the median range here, and it was actually quite strong year over the last couple of years, but now it's starting to come back down to that median area, and it'll be interesting to see where this kind of ebbs and flows. Be around here, then we're kind of back to the start to push up again. That could have definite impact on prices as more and more Canadians have more income coming in to put towards a mortgage. Now let's look at the Canadian interest rate. This is the Bank of Canada overnight rate. We're sitting at 2.25%. We can see that from 2009 up until around just before 2023, so during 2022, interest rates were cheap, significantly cheap, cheaper than in the past. And that had a lot to do with some of the big price increases that we saw in the real estate market. When you're able to get a interest rate below 2%, that will send prices quite high, because people understand that in order for their money not to depreciate, they're going to need to put it into assets. And that's why people went out and bought homes, because inflation was typically going above 2%, but you're borrowing at less than 2%. So, just to reiterate, we're still sitting higher than we have since. So interest rates are significantly stretched right now, and they're not for sellers to be accelerating here. Next up, we're looking at Canadian 5-year bond yield, and it's been super choppy over the last couple years. We've just been sitting in this range, and we can go back, and it's a lot like the variable rate, which is Bank of Canada overnight rate that we just looked at. The fixed rates were low as well, and we had our little peaks and our valleys, but during COVID here, 2015 to 2017, where we saw prices in the GTA accelerate quite a bit, this was interest rates, the heavy lifting in those price points. So in order to see anything meaningful, we're going to interest rates come down. The only problem is a lot of different data points are suggesting that we're likely going to be climbing when it comes to rates, both from the Bank of Canada and the bond. Next, we're looking at Canada's core inflation rate year over year, sitting at 2.3. And, this is quite elevated. We need to get down to be bouncing around to 2%. We need the ebbs and flows here, and we're still quite elevated here. So that's going to give the Bank of Canada some pause until we see or the jobs markets weaken from here. Next, we're going to be looking at the Canadian Consumer Confidence Index. And, we can clearly see it's been on a downtrend since 2021, where the consumer confidence has just not been there. Now, it's very possible we're starting to form a bit of a bottom here, and we could start to see it strengthen. It has been strengthening. Typically, 50 is your median, where anything of that, it's starting to get consumers a lot more confident. Anything below that, we're going to need to see some improvement when it comes to that. Another thing I like to look at is the Canadian Central Bank balance sheet. When we're looking over here in this area, this is what the Canadian central bank balance sheet was after the great financial crisis in 2008. You can see that they took on some significant debt there, but when it's compared to COVID, it's almost laughable, to be honest with you. This is what happens when the Bank of Canada is going to be the only buyer of bonds that the government's issuing for debt. Number one. Number two, they also need to drive interest rates lower to spur economic activity. And if no one's willing to buy those bonds, or they want a significant premium on the yield for that, well, the Bank of Canada can't have that, because it's going to stall the economy. So what ends up happening is they start to buy all the bonds, and they start to put it on their balance sheet. And this is what they did. They went from basically, $125 billion on the balance sheet up to $575 billion on their balance sheet. That's how much it took to keep rates low and get Canada through that. They've been letting the bonds roll off, and we can see that it's been quite a straight line down up until recently, where we're starting to chop to the sideways a bit, which tells me we're getting close to a point where they can't let any more roll off, and they might need to start purchasing the bonds again, especially if we start to see interest rates on the bond market start to creep up. They might have to start buying these bonds to make sure that they're keeping rates low enough. We've got a lot of refinancing that's going to happen this year. So it'll be interesting to see if the Bank of Canada steps in and starts adding to their balance sheet. Next up, we're looking at the Canadian government revenue. So going back to 1985 all the way up, it's a pretty straight right, heading to the top of the right. And the pandemic happened, and look at the amount of additional revenue that the government's seeing here. Now, a lot of that has to do with inflation in the economy. If something costs you $1, now it costs you $2. Instead of the government getting maybe 8 cents or 7 cents, they're getting 14 or 16 cents on those products. So don't forget, inflation happens. It also makes the government's ability to get revenue a lot easier. So, and that's what we're seeing here. We're seeing a huge deviation from the historical line that we've seen in the past of what the government is bringing into their coffers from the revenue side. So let's look at some of those headlines here. Inflation is holding 2%, but the Bank of Canada says more volatility is coming. Here's what to do. So we've got Carolyn Rogers here, who came out, and this was done on April 8th. And I'm just going to read this for you. In a speech given to the Manitoba Chamber of Commerce at the end of March, Bank of Canada Senior Deputy Governor Caroline Rogers acknowledged that Canadians who had lived through 5 years of economic upheaval may need to brace for the next half-decade. Speaking in Branding, Manitoba, Rogers outlined a list of current structural forces reshaping how the central bank thinks about inflation, prices, and economic growth. In particular, she highlighted that the new oil price shock from the conflict in Iran, the U.S. protectionist trade policy, Canada's slowing population growth, and the rise of artificial intelligence are all problematic themes that will continue to impact Canada's economic health. While the annual inflation rate cooled to 1.8% in February, Rogers and many other economists expect this rate to rise in the months ahead as higher gas prices persist and tariffs continue to hurt specific sectors in the economy. Now, if you're having inflation rising over the coming months, it's very hard to be able to be cutting interest rates in a market that clearly somewhat needs the interest rate cuts. There's a lot of debt rolling over this year. There's a lot of business debt, government debt, provincial government debt that needs to be, and they're refinancing this year at a significantly higher rate than they were in the past. So these are definitely some significant headwinds that the Bank of Canada is even talking about here. Next up, from Better Dwelling, we have the Canadian variable rate mortgages surge as the Bank of Canada recreates the renewal trap. So what they're saying here is the Canadian borrowers are aggressively returning to variable rate loans after hitting record lows just a few years ago. The Bank of Canada data shows uninsured mortgage funds advanced, cash lenders provided for originations, renewals, and refinancing hit a new peak in January. While the overall funding reached a monthly high, annual growth is slowing, masked by some of the strongest variable rate loan activities in years. So we can see this absolutely is, go all the way back to 2014, we had some very strong variable rate mortgages at the end of 2021 and into 2022 because fixed rates had already started to move up. So anyone that wanted to get into the market at the later stages there, they really needed to go on the variable to be able to afford the mortgage. And what ended up happening was interest rates started to go up and they kind of got squeezed at the seams there. And the unfortunate thing is so much money was printed by the Bank of Canada that a lot of people at first didn't really realize just what was going on. And then they didn't expect, and myself included, rates to go as significant as they did. And now in hindsight, you look back and when you look at what was put on the central bank balance sheet, just how significant the money was in the market. And we've actually gone above that now. Now, the issue we have with that, and I'll get into that in a second. Let's just go over this chart. The variable rate loans is a share of funds advanced by lenders for residential mortgages in Canada. We can see that we're climbing back up there, close to almost 50%. And the reason somewhat worrisome is look at the gap between the fixed and the variable, right? So the bond market is telling us, hey, we might need higher rates jumping in over here, and it's very possible that we start to see a couple more upticks in the variable side. So I would say that if you are thinking about a variable rate mortgage, obviously talk with an experienced mortgage agent who also has a little bit of understanding of what's going on the economic side. Because if you're jumping in just because it's the cheaper rate, you need to be able to at least absorb a couple rate hikes if they happen. Because right now, if we're looking at the Wawa data for changes in the Bank of Canada policy rate as implied by the forward contracts on Canadian overnight repo rates, we can see as of April 6th that right now, there's no rate cuts expected. We're looking at a rate increase in possibly September with a 57% chance of a rate increase. And we're also looking at an 89% chance of another rate increase to 2.75% in the beginning of January. So it is very possible that we could see those two rate increases. I get it. A lot of people there are saying, how could they, there's no way I can see this market that we're in. The economy is clearly struggling, but at the end of the day, the Bank of Canada is more worried about inflation and it peaking back up to where it was before. We saw this happen before. I believe it was in the 60s or probably the 70s, where we saw a double bounce in inflation. And the Canada and central banks around the world do not want that to happen again. So they will try and protect that from happening at all costs. So going back to that, if you are looking at variable rate interest rates, make sure that you can absorb at least a couple of rate hikes in the event that they do happen. Now, let's look at Canada's population shrank last year for the first time for this country, StatsCan says. So we can see the chart on the right side here. We can see we typically very steady with our with our population growth. And then the population growth grew quite significantly as we welcomed a lot more people into the country during the pandemic. And then now that's fallen off significantly and into the negatives. And at the same time, we were an insane amount of rental properties because at the time we were saying, hey, we need more properties in the market. Clearly there's massive demand there. Well, it turns out that we were just letting in so many people at that time that it was putting a lot of strain on the housing market. And this will also affect the market over the next couple of years, is if we don't start to see the population start to increase, it's hard to see any significant movement to the upside in the price points for properties, especially in the GTA. So let's kind of see how this is all tied into the market. What this chart is showing us is how March has compared to past Marches, going back March of 2015. So we can see that prices are still trending downwards. Transaction volume has kind of stabilized here, but we've seen it stabilize, but it was coming down. So nothing too telling there. We're going to want to see in future months if it's its way to the upside. When we're looking at the new listings volume, we can see that that's kind of rolled over. And that goes back to one of the Ipsos charts that we had earlier, which showed less people were likely to put their property on the market this year. And this is what we're kind of seeing in the data in real time. So the Ipsos data is so valuable, especially for real estate agents and anybody looking to participate in the market, because it's giving you a clear picture of what's going on in the minds of buyers and sellers. And now we're looking at the average days on market. We can see that we're up in the 30s now. So that's accelerated. It takes longer to sell properties. Active listings has started to roll over. And the one big reason for that is we're starting to see new listings come down. We were 17,142 last year. We're down to 14,341 this year. And then looking at months of inventory, we can see that we finally rolled over. And again, that has a lot to do with the new listings and the transaction volume stabilizing. And when we just kind of break down, this is a month till now. When it comes to the sales volume, you can see we're still trending to the downside. When we see a change in them, we want to see a bit of a higher high and then a lower high to start to show the change. Right now, we're making lows, lower highs. It's not trending in the right direction. Where you see from 2018 and up, this is the kind of direction that you see in an improving market. When it comes to active listings over here, we can see that they're just piling up, and the lows are getting higher almost every time. So we can assume that this line, we want to see it not peak past this. This is going to tell us that, okay, individuals are not dumping their properties on them because they have to. They're just going to wait. And this will ultimately help the market, help the active listings come down, which could form a bottom in this market. And then looking at the median sale price, we can see we peaked out in 2022 and then came down quite sharply. And it's kind of it chopped sideways up until recently. Still are making our way down when it comes to the price. I fully expect that the rest of the year, this will chop sideways to down to finish out the year. So that's going to do it for this month. It's a ton of it there for you. Ipsos data is crucial when trying to understand what's going on in this market and what direction this market is potentially heading towards. So if you enjoyed that, please share it with anybody you get any value out of this. And if there's information or there's economic data that you want us to cover for you in the future, drop a comment down below. We'll definitely include it for the next month. Guys, thanks for joining.